Hello and welcome to the Mazars Australia 2021-22 Federal Budget presentation. My name is Jamie Towers. I'm a tax partner in Brisbane, and I'd like to welcome everyone for viewing this budget presentation. Now, the federal budget was the second of the COVID budgets with enormous stimulus to keep the economy in positive territory. Today, we intend to demystify the tax and superannuation changes announced in the federal budget. But before we begin, I'd like to just take you through our agenda for today. All right, today we intend to take you through the individual tax changes impacting individuals. And then we'll look at, well, what has changed for business taxes? And there's an enormous amount of stimulus intended to get businesses spending in the economy and keeping that economy going forward. And then following that, we'll look at the superannuation changes. There was a few surprises in the budget, and Clive Todd will take you through some of the superannuation changes. Following all of that, we'll talk about, well, what are some of the key areas you need to concentrate on as we move into the financial year end, and we'll look at some tax planning scenarios. But before we start all of that, I'd like to just consider what are the key economic measures that were in the economy. Now, the government is aiming to bring the employment level down below 5%. That's one of their key goals. And how are they going to go about that? Well, they're spending money. They've announced last year that they were predicting over $200 billion in budget deficit, but that has actually come in much lower than anticipated, some $52 million lower than they intended to or anticipated spending. The government were much further ahead in the economy than what they had anticipated. They had spent or anticipating spent some $52 billion less than what they had previously anticipated. And were they going to save that money? No. They've decided to spend it on ongoing stimulus in the economy. So they're predicting that the 2021 year budget deficit will finally come in at around $161 billion. And they're forecasting that over the next financial year, to 2021 to 2022, they'll spend $106 billion. So that's significant spending to stimulate the economy. Now, overall, we're predicting that the level of net debt per GDP will come in at about 40.9%, which is a huge level of debt, never seen before in Australia. However, when you compare that to large overseas countries, the US, for example, is at about 90% net debt to GDP. And we're forecasting that the UK will be in excess of 100% net debt to GDP. So Australia is very mild in comparison. So what is the government spending all this money on? Well, they are anticipating that to bring the economy back into the black in the future, they need to create jobs. So one of the key focuses of this budget is creating jobs. So they're looking at skills and training. They're looking to bring in funds to create more than 170,000 new apprenticeships. They're going to spend money on infrastructure. Now, in the last budget, some 6-7 months ago, they were predicting an $110 billion budget infrastructure pipeline. And they've announced a further $15 billion of spending on infrastructure. They're looking at building our international capabilities. Now, they're creating a patent box to invest in intellectual property, and Gabrielle will speak about that later. They're investing in childcare to get both parents into the workforce. So it's all about creating jobs to help have income in the hands of the general public and spending in the economy and keeping the economy going. So now I'd like to introduce Evan Beisel. Now, Evan is a tax partner in our Melbourne office, and he will speak with you about the tax changes in the federal budget that are impacting individuals. Thanks, Evan.
Well, so I'm going to take us through some of these tax changes impacting individuals. Firstly, a few key themes here. Well, as Jamie says, there is some stimulus in this budget, and that does extend to the measures for individuals. We've got some small fixes around the edges. The budget really has a flavour of a pre-election budget, and in that there's a few sweeteners, but nothing greatly offensive that's going to upset anyone too much, I don't think. What we don't have is any major structural reform. So to start out, let's have a look at the tax rates that are applicable for individuals. Now, in this budget, there was no change to the already legislated three-stage tax cut plan. So you may remember from a couple of years ago, the government announced and then legislated a three-stage tax cut plan, where in stage 2 of that right now, having that been brought forward in last year's budget. And so that stage 2 is those rates on the left there in the table. And then from 1 July 2024, we moved to the stage 3 of that plan. And you'll see that the key difference between the rates we have now on the left and the stage 3 rates on the right is that 30% band, all the way from 45,000 to 200,000. So a really significant flattening of the tax rates. So as I said, this is legislated, but it is not without controversy, and there has been quite a bit of commentary that these tax rates might not survive until their implementation. But for now, that's what we're expecting to see. To give you an idea of who benefits from that stage 3 tax cut and how much of a benefit that is, the next slide shows you at a few different income levels what that means. So for income levels at 100, 150, 180,000 and 200,000, you can see the tax savings under the stage 3 tax cuts there on the right. So ranging from around $1,400 to just over $9,000. So not groundbreaking, but meaningful tax cuts for taxpayers in those income ranges. And just to clarify, it is those higher earning taxpayers that really benefit from the stage 3 tax cuts. So let me talk a bit more about what some of the announced changes were in the budget this year. So firstly, we've got an extension to the low and middle income tax offset for an extra year. So this is the $1,080 or up to $1,080 tax offset that we currently have that applies for people earning up to $126,000. So that's being extended for another year through to 30 June 2022. Now, the government would like you to think that that's giving you a tax cut. In fact, it's more saving you from having a tax increase, because that offset is there now. It was going to fall away from 1 July. Now it hangs on for an extra year, so there's no change to tax for those people until the following year. Secondly, reform of the individual tax residency rules. I'll go into that in a bit more detail in a moment. A really interesting but in some ways insignificant measure, the removal of the $250 exclusion threshold for self-education expenses. So under the current rules, if you're studying a course that relates to your employment and you're claiming self-education expenses, you have to disregard the first $250 of expenses as a tax deduction. And this measure announces to remove that, what is really an absurd adjustment to your deductions for self-education expenses. So that's welcome and sensible, but I'm not sure how much of a difference that extra $250 deduction is really going to make. I'll also just mention briefly, whilst it's not strictly a tax measure, the childcare subsidy changes will be important for many families, and that's to increase the subsidy rate for second and subsequent children up to a maximum rate of 95%, as well as removing the approximately $10,000 annual cap that applies for higher income families. So very welcome changes for many families. So the tax residency changes are probably the most significant announcement for individuals in the budget. Our current tax residency rules are quite cumbersome. They rely on over 100 years of case law, and some elements are really quite subjective and can be really difficult to apply. And on the whole, they're just simply not fit for purpose for a modern mobile workforce. And so we've had a couple of years ago a report from the Board of Taxation that proposed reform in this area to a simpler set of tests that are easier to apply and more fit for purpose. And the government's announcement is that they want to implement new rules based on the Board of Taxation's recommendations. Now, we know what the Board of Taxation recommendations are, but we don't know exactly the extent that the government will implement them in line with those recommendations. But what we do know is that a key feature will be a 183-day bright line test. So being that if you're in Australia for 183 days, you will be a resident for at least part of the year. And that's intended. And so alongside that will be a number of secondary tests where needed, but importantly, and the quote there on the screen, measurable objective criteria. And that's the key. The idea of these new residency rules is to move away from subjective criteria that can be really quite difficult to determine whether or not you're a resident in some circumstances, to these measurable objective criteria, which will provide more certainty for taxpayers as they work out their residency status. So I think on the whole, this is really a very welcome announcement. I think, however, what remains to be seen is what is the detail of the rules. Will the rules strike the right balance between protecting Australia's tax base but allowing individuals who are genuinely living overseas to cut their ties from the Australian tax net and become non-residents? So, we'll be really interested to see that when the legislation comes through. And look, that brings me to the end of the tax changes for individuals. I'll hand back to Jamie.
Great. Thank you very much, Evan. Some good initiatives there to keep individuals spending in the economy, and hopefully some clarity around those individual residency changes once they are implemented. Right, I would now like to welcome Gabrielle Cleary. Now, Gabrielle is the tax partner in our Sydney office, and she's here to speak with us about the key business measures that were in the federal budget affecting taxes. So over to you, Gabrielle. Thank you.
Thank you, Jamie. Hello, everyone. As detailed, I'll provide an outline of the principal business taxation measures which were announced in the budget. The main measures available for general business this year feel a little like Groundhog Day, as they were merely extending the provisions which were introduced in last year's budget. These measures provide a one-year extension of the previously introduced temporary full expensing of assets and the company loss carryback rules. As a reminder, the temporary full expensing of asset provisions allow for eligible businesses to be able to deduct the full cost of new depreciable assets acquired by a business irrespective of value. As a result of the extension, the deduction is available to assets acquired during the period from 6th of October 2020 that are first used or installed ready for use by 30 June 2023. The deduction is available in the year of first use. This deduction is available to be claimed by any business with an aggregated annual turnover of less than $5 billion. For small business entities and medium-sized businesses, being businesses with less than $50 million turnover, this deduction will also be available for the acquisition of second-hand assets. As you would be aware, the ability to claim an immediate deduction for the cost of acquiring a depreciating asset has progressively increased since 1st of July 2016. This history is illustrated in the following table, which shows increase in both the financial caps for asset costs from $20,000 to unlimited, as well as the turnover threshold for eligible entities from $10 million to $5 billion. The other extended provision relates to the loss carryback rules, which were announced in last year's budget. These have also been extended by 1 year to apply to the 2023 financial year. In this manner, companies that have a loss in any of the 2020, 21, 22 or 23 financial years are able to carry the loss back to an income year in which tax was paid in any of the 2019 or later income years. The refund is payable as a tax offset on the lodgement of the tax return for the 2021 income year or any later years. The refund available is limited to the income tax that was previously paid and is only available to the extent that the refund will not result in a franking account deficit. This provision again is only available for companies with aggregated turnover of less than $5 billion. A company is still able to choose to either carry back or carry forward any of the tax losses subject to meeting the requirements. Later in the presentation, my colleague Ashley Goodman will provide an example which will incorporate how both the loss carryback rules and the temporary full expensing provisions apply in practice and how they can be used in tax planning. The main new tax measures that were introduced in this budget can be summarised as changes to the employee share scheme provisions, the introduction of the self-assessment of effective life for depreciation of intangible assets, the introduction of the patent box tax, and the 30% digital gains tax offset. I'll provide an overview of each of these changes. The announced changes to the employee share scheme provisions relate to both income tax and regulatory requirements. From a taxation perspective, it is proposed that the cessation of employment will be removed as a taxation point for ESS interests, such as shares and options, acquired under a tax-deferred scheme. The change is intended to enable an employee to better have the means to pay the required taxation on their ESS interests. For example, under the existing rules, if ESS interests are maintained on cessation of employment, and this would give rise to a taxation event, there would still be disposal restrictions on those interests which would prevent their sale. This would require the employee to obtain the necessary cash funds to pay the tax from other resources, which may result in undue hardship. By removing cessation of employment as a taxation point, it is more likely that the employee will be able to sell all or part of their interests to meet the applicable tax liability from the receipt of these interests. So as a result of the change, the deferred taxing point for an ESS interest, that is a share, will be the earliest of the following. The first time that there is no risk of forfeiture and no disposal restrictions attached to the shares, or 15 years after the date of acquisition. For an ESS interest that is a right or an option, the deferred taxing point will be the earliest of the following. The first time that there is no risk of forfeiture and no disposal restrictions attached to the option itself. When the employee exercises the option, the first time that there is no risk of forfeiture and no disposal restrictions attached to the share acquired, and 15 years after the date of acquisition of the option. Note that the provision is proposed to apply to ESS interests issued on or after 1st of July following the date of royal assent. As a result, the cessation of employment will still be a taxing point for ESS interests issued prior to that date. In practice, when dealing with the taxation of ESS interests issued, you must be aware that any issued before 1st of July 2015 have different taxing points. For example, vesting of options is a taxation point for those options. The budget also announced regulatory changes to remove the disclosure requirements for employee share schemes where employers do not charge or lend to the employees to whom they offer the scheme, and for all other employee share schemes to increase the value of shares that can be issued to an employee utilising the simplified disclosure requirements from $5,000 to $30,000 per employee per year, and this relates to unlisted shares. These changes will apply for all issues made after 3 months after the date of royal assent. The next change that was announced enables businesses to undertake a self-assessment of effective life of intangible assets for the purpose of claiming capital allowances or depreciation. This applies to intangible assets that are depreciating assets which currently have a fixed effective life, being patents, registered designs, copyrights, and in-house software. Under this provision, taxpayers will have the ability to choose to apply a self-assessed effective life or continue using the prescribed rates and periods. The provision will apply from 1st of July 2023, which is when the temporary full expensing provisions are due to finish. The next change is that the budget is proposing to introduce what is commonly referred to as a patent box tax regime. Under this regime, the income derived by a company from patents will be taxed at a concessional corporate tax rate of 17%. The provision will only be available for income derived from Australian medical and biotechnology patents. The concessional tax will apply from 1st of July 2022. However, it will only be available for patents that applied for after the budget announcement, being the 11th of May 2021. The other major tax concession introduced is for the gaming industry. The government has announced that it will provide a 30% digital games tax offset to help stimulate investment in the industry. The tax offset will be available for eligible businesses that spend a minimum of $500,000 on qualifying Australian games expenditure. The government will consult with the industry to determine what will constitute this qualifying expenditure, and the offset will not be available for any games with any gambling element or that cannot obtain classification. This offset will be available for Australian resident companies and foreign companies with a permanent establishment in Australia. The offset will be available from 1st of July 2022. Just in closing, I'll briefly mention some of the other relevant provisions announced in the budget for businesses. There will be an income tax exemption for qualifying grants made to primary producers and small businesses that were affected by storms and floods in Australia in February and March 2021. These grants will be treated as non-assessable and non-exempt income. There's also been an increase in the excise refund cap for small brewers and distillers. The excise refund for small brewers and distillers will be available for the full amount of excise up to an annual cap of $350,000 from 1st of July 2021. And finally, small business entities will be able to pause or modify the ATO debt recovery for matters being disputed in the AAT until they are determined. This will be a welcome relief for people dealing with the AAT, as previously the ATO have demanded payment prior to determination. This provides a summary of the main business tax provisions that were announced in the budget. I'll now pass back to you, Jamie. Thank you.
Great, thank you very much, Gabrielle. I think there's a few surprises in there, and also some same old in relation to some of those tax measures. I'd now like to welcome Clive Todd to speak about superannuation. So Clive's one of our Brisbane tax partners, and he looks after our self-managed superannuation fund division. So welcome, Clive.
Thanks, Jamie. As stated earlier, there were a few surprises in the budget this year for superannuation, and luckily they were all good news. The first one that I was most excited about is they're abolishing the work test for some contributions for people aged between 67 and 74. So currently, a bit of a recap on the work test. If you are aged between 67 and 74, you need to be working 40 hours within a 30-day period prior to making any contributions to your superannuation fund. That will cease for some contributions, including non-concessional and salary sacrifice. Now, non-concessional is fairly self-explanatory. Salary sacrifice is a bit more of a strange one because people think, well, aren't you working if you have salary sacrifice contributions? But it's aimed likely at people that are working part-time in a directorship, and they're not necessarily doing that 40 hours in the month, but maybe only 10 to 20 hours. So they will be able to make those salary sacrifice contributions as part of this change, which is proposed to come in from the 1st of July 2022. Even more exciting, I think, is the fact that the bring forward rule will apply for the non-concessional contributions. So currently you can't even do that after the age of 65, even if you are working. So that's coming in as well, which means that you will be able to put in 3 years worth of your non-concessional contributions in one hit. These are subject to the existing caps and the existing restrictions around your total superannuation balance. So keep that in mind and just be careful around that. Unfortunately, there is a catch with it. It is not all contributions. Personal concessional contributions, which is those contributions that you claim a personal tax deduction for, you will still need to satisfy the work test to make those contributions post July 2022. So it's not all contributions. Any ones that you're making personally that you want to claim a tax deduction for, you will need to satisfy the work test. All in all, though, some pretty encouraging legislation, I think, which is giving people the opportunity to further increase their superannuation and their retirement benefits. Not only from outside funds going in, there will also be some planning opportunities around evening of member balances between spouses, and also some utilisation of withdrawal and recontribution strategies. So I think over the next 12 months, we'll be looking at a few of these options and talking to clients about what they can be doing with this rule. Next, we had the downsizer eligibility age reducing. So currently, it's 65. If you sell your main residence that you've held for 10 years, you can put in a downsizer contribution of up to $300,000 per person. That's coming down to 60 years old. So that's going to be open up to a lot more people selling their properties that will be able to take advantage of this measure. All the other eligibility criteria remain the same, and it is slated to start from the 1st of July 2022. One catch to keep in mind here is that the preservation rules are still the same. So if you are 61 making a downsizer contribution post July 2022, you may be in the situation, if you haven't met a condition of release, in that you can't pull it back out of your superannuation fund. So again, not necessarily an issue, but just something to be aware of. This one was leaked obviously prior, but the removal of the threshold for superannuation guarantee is going to occur likely from the 1st of July 2022. Currently, if you are earning less than $450 in a month, there is no requirement for your employer to pay superannuation guarantee on your behalf. That minimum threshold will disappear, and hence you will have contributions made on your behalf. There's a bit of concern around this and that it will add an administrative burden to employers, but I like to think with the way that software is set up nowadays, it should be fairly negligible, and what it will result is an estimated 300,000 people will suddenly be receiving further superannuation contributions that they weren't in the past. So I think good news in the long run. A long-standing disadvantage of self-managed super funds has been some of the residency requirements around them. So for people that move overseas for work, family, etc., if they have a self-managed super fund, they can run into trusteeship issues. So currently there's a safe harbour provision that if you are temporarily absent for 2 years, you can remain as a trustee. They're extending that to 5 years. So it probably comes more in line with the reality of people moving overseas, working overseas. Post-COVID especially, it's more of a global place that we all live in. So that will hopefully add a bit more flexibility to people with self-managed super funds. And even more beneficial, they're removing the active member test, which means those members and trustees while they're overseas will likely be able to make contributions to their self-managed super fund other than in the past only been able to do that into large APRA-regulated super funds. Again, this is likely to come in place from the 1st of July 2022. Legacy retirement products. There's a lot of these going back to pre-2007, mid-2007. People put in some, which are long forgotten now, but some different types of products around market-linked pensions, lifetime pensions, life expectancy pensions. They're still stuck with them. They haven't been able to do much with those pensions since putting them in place. And a lot of people are not necessarily getting the benefits that they once were. Well, the government's going to allow a 2-year window where they can deal with them. They can convert them to account-based pensions maybe, pull them out, put them into accumulation depending on the individual circumstances. But from the 1st of July 2022, there will be this opportunity to do something with them. It's important to note that a lot of these were entered into for the Social Security, the Centrelink benefits that were attached to them. If you are making changes to these post-July 2022, then keep in mind that those Social Security treatments are lost. So don't just do it without first looking at what the ramifications may be. But still, great to see that there's further flexibility, further opportunities for people to deal with some of these things that have been sitting around for a long time. And finally, as part of the ongoing housing affordability issues that the government's trying to deal with, they are increasing the amount that people can access via the First Home Super Saver scheme from the current $30,000 up to $50,000. I think it's important to note here that you can only be having voluntary contributions that you'll be able to access of up to $15,000 per annum still. So if you are wanting to take advantage of the increased $50,000 threshold, which again will likely come in from the 1st of July 2022, you will need to be building that up over a number of years. $15,000 a year will take you a bit over the 3 years to get that in, and then you can take advantage of that. So that's pretty much the main changes, the main announcements around superannuation. I think all in all, some good steps forward. Yes, there's some complexities in it, but I think there's a lot of opportunity there, and I look forward to exploring some of the strategies that we'll be able to sort of utilise for our clients. Back to you, Jamie.
Great. Thank you very much, Clive. That was very insightful, and some good measures finally coming through for superannuation after a quiet couple of years. I'd now like to welcome Ashley Goodman to present on some of the measures that have been announced previously but haven't been enacted, to recap on those, to talk in a bit more detail about those loss carryback rules, and to explore some year-end tax planning considerations. So over to you, Ashley.
Thanks, Jamie. I'm just going to briefly touch on a few of some previously announced federal budget measures that have not yet been enacted. Last year, there was an announcement about changes to fringe benefits, and this was in regard to employer providing retraining and reskilling, where you incur these expenses that would be exempt from FBT. And there was another announcement about the burden of record keeping. In this regard, the ATO was going to apply discretion and be able to accept corporate records rather than relying on employee disclosures. We are still waiting on the changes to the technical amendments to the corporate residency test. So while there was an announcement to the individual residency test, consultation continues on the corporate residency test rules. Last year there was an announcement regarding an exemption on CGT for granny flat arrangements, and we've still not heard anything regarding that. For many years now there's been talk about reforms to Div 7A or Division 7A. They are a complex set of rules, and we're yet to see any reform in that space. There has been previously an announcement regarding the reporting regime for sharing economies. So this would be Uber and Airbnb and the likes of those. The ATO would like a reporting arrangement in place for the payments made to their users. The introduction of the corporate collective investment vehicle. So this was announced in this year's budget that it would have a revised date of 1 July 2022. And a corporate collective investment vehicle is a corporate vehicle where taxpayers are taxed on a flow-through basis and they're taxed on the underlying assets of the vehicle. So I'd like to move on and talk about some tax planning measures that we have been talking to clients regarding, particularly what Gabrielle touched on in relation to the temporary full expensing of depreciating assets and also the company loss carryback measures. There's also opportunity with the increases to super guarantee and the change of tax rate for tax-based entities just to around timing for the payment of some larger expenses and to take advantage of these. Now I'm going to go through a practical example. This example uses a company that is taxed as a base rate entity. So our base rate entity is taxed currently at 26% and next year it will be moving to a 25% tax rate. For the 19 and 20 year, we had a 27.5% tax rate. In the 2019 year, this company has a taxable income. The taxable income for the 2022 year, potentially with the impact of COVID, has decreased. And then in this example, they've utilised the temporary full expensing of depreciating assets in 2021 and 2022, and then we've carried back that loss and taken advantage of those measures. So in 2019, we had a tax paid amount of $82,500. And we can see in 2021, we've had a tax loss of $26,000. So if we look down the column of 2019, when we've done our 2021 tax return, we've applied that tax loss to the 2019 year. And this company has received a cash tax offset for that amount. Then in the 2022 year, there's been a tax loss of $100,000. And so the 2022 tax return, we have applied $56,500 as a loss in the 29 year, and then the full amount of the 2022 loss has been applied. So what this is doing is is giving support to businesses by monetising revenue losses and giving them cash and cash flow rather than deferring it for future profitable years. The leftover amount of $16,000 from that tax loss in 2022 has then been carried forward to the 2023 year. So you do have the option to carry back or to carry forward, and you can obviously opt in and out of the temporary full expensing options as well. It's important to know that the tax loss that gets carried back is based on the tax rate of the year that the loss is made, and that's the year that the loss is applied. For example, for the 2021 year, the franking account of that year has to exceed the amount of the offset that's received. We'll move next to expense planning. So again, we're using a base rate entity where the tax rate has changed. In this example, I've used a simple 1 month payroll, a bonus that will be paid for the year, and the super expense that will come from those two previous expenses. Now, this entity, in both situations, we've got one where the expenses are paid on the 30th of June 2021 and then on the 1st of July 2021. So we've got in the 2021 tax year and the 2022 tax year. So if we look at our expenses in the first column, we've actually moved forward a payroll month by 1 day or by a few days if you can, to increase the value of the deduction because you're actually getting 26%. And as with the bonus. Now the super rate is going up, the super guarantee rate. So you're having a savings of being able to pay super at that lower rate. And when you look down at the taxable income, despite that taxable income being higher for the 2021 year, our value of deductions are greater than the 2022 year. So it's just some simple ways in which you can use timing of expenses just to save some money coming into the year end. And that's it for me. I'll hand over to Jamie. Thank you.
Great. Thank you very much, Ashley. I'd now like to wrap up just with a couple of ideas for individuals and family groups as they go about end of financial year planning. So as Ashley just illustrated, it's always better to try and bring forward expenditure to get a tax deduction earlier, and certainly in the case of companies, when we've got a changing tax rate, it is more beneficial. But just some ideas for individuals. Similar principles work. If you can bring forward the expenditure, you're going to pay less tax now and more tax in the future. So if you can pay tax now, less tax now, it's always a good thing. Now, one thing that Clive had touched on was the superannuation carry forward concessional contributions. And that's where each year you've got a concessional cap. So currently it's 25,000, moving forward to 27,500. So that's the maximum you can put into superannuation and claim as a tax deduction. Now, since the 2018-19 year, if you haven't used the full amount of that $25,000 cap, you are able to carry the balance of that cap forward into a future year. So one idea, if you're looking for tax deductions in the 2021 year, if you've got excess cap, why not use it? So as an example, in 2020, you only put $20,000 into superannuation and claimed it as a concessional contribution. So therefore, there was $5,000 excess. So in 2021, you could actually put the $5,000 in plus the $25,000 to get an overall deduction of $30,000 in the 2021 year end. Now, just because you can claim a tax deduction doesn't mean you should do it. So you should always talk with your financial advisor before considering making a contribution to superannuation. But key principles, bring forward expenditure and consider whether or not superannuation contributions are correct for you. Now, I'd like to touch on trusts. There was no mention of trusts in the budget. Whether that's a good thing or a bad thing, I don't know. But as accountants, dealing with the tax office on a regular basis, we are seeing that the tax office, the ATO, have a continued focus on trust distributions and some of the anti-avoidance rules around trust distributions. So the final message I'd like to leave people with is if you've got a family trust and making a decision as to who to distribute income or capital to at the end of the financial year, is take advice. Speak with your accountant ahead of 30 June, decide what's appropriate for you, and make sure that you document those trust resolutions in writing before 30 June. And talk with your accountant about the anti-avoidance rules. What are the government focusing on so that you don't fall afoul of those? So as we're coming towards 30 June, it's a really great idea. Speak with your accountant. Have a review of how your personal situation's gone to date or how your business situation's gone to date, and look at what's the likely tax position going to be at year end. And what are the key strategies that you can take that are right for you, your family and your business to help reduce tax for the year ended 30th of June 2021. So with that, I'd like to wrap up the presentation. Thank everybody for listening in. We're just seeing a disclaimer on screen now. So all of what we've talked about is just general advice. Most of what we've spoken about is just in relation to budget announcements. They have not been legislated yet, so they're not yet law. So before making any decisions, speak with your accountant, and take the right advice. So I'd like to thank everyone for listening and have a great day.